Hello everyone, welcome back. Today we are listening to great investors like Warren Buffett, Charlie Munger, and more to learn their thoughts on diversification. Diversification is a controversial topic for a lot of investors, so the only thing I ask is please first listen to the video before typing up a comment. Even if you don't agree with everything these investors say, it's always good to hear the other side of the argument and evaluate its merits. So hope you guys enjoy.
So tell us a little about your portfolio. Why so few names? Obviously there has been some rumors of the performance up 6% for the first quarter. I know you can't say that's accurate or not accurate. With most of your portfolio up double digits. One down to double digits, which we'll talk about. But give us just a take on why so few names, and
So for a bunch of reasons. I mean, I've always had the view that why not own the best 10 or 11 investments as opposed to ideas 12 through 25 or 12 through 100, which is more typical. And I think there are very few great investments at any one time. So the ability to concentrate is an enormously valuable asset of a strategy. The problem with it is it leads to bumpier returns, and it leads to more attention on mistakes or things that aren't going well. I don't know a portfolio manager that doesn't have a stock that's down in his portfolio, right? But you don't read articles about. We're getting an awful lot of attention for a pretty high-profile situation that's struggling. But I think there's. It depends on what your business model is. But if you want to make high rates of return over a long period of time, it's hard to do that being very diversified. I mean, if you look through the Forbes 400, wealthiest people in the world, most of them made their fortune in one business or a portfolio of two businesses. Very few made it in a portfolio of 100. So it's that. And the other benefit, it allows you to run a much simpler investment firm. We have an 8-person investment team. If we had 30 names, we couldn't manage that portfolio the way we do with a small team. By having a small team, you can hire better talent.
There's actually an argument that some people are now making that, buying the index or buying diversified funds have had much better returns than buying, those hedge funds that have, a very specific smaller portfolio approach like yours.
I haven't seen that article. I mean, I think we've done very well relative to any index alternative, certainly. So it depends on how you judge us. I think if you judge us on a 90-day basis, I have no idea how we're going to do relative to an index. But I think this is a strategy that over time should earn a meaningful premium over any kind of benchmark, or you shouldn't give us your money.
Yeah. So talk to us about the Bill Ackman strategy, or that mental checklist that you go through before deciding to go long or short a position. I mean,
first of all, it's not a Bill Ackman strategy. It's a Pershing Square strategy.
Pershing Square.
And I do get a fair amount of the.
But you have the final say, yay or nay.
That's correct.
Okay, so some could depict that.
I'm
as
a CEO. The buck stops with me.
Okay.
Absolutely.
We just want to make sure that it's
good
not
ones and the bad
totally
ones.
management by committee.
That's correct.
Okay.
That's correct.
So,
but just to be clear, every idea has a leader at Pershing Square, and the leader may not be me. Sometimes it's me, sometimes not.
Go through that strategy and go through how it works, and when you come, maybe you'll override that portfolio manager or not, but what's the checklist you kind of go through?
So we look for very high quality businesses, what we describe as simple, predictable, free cash flow generative, dominant businesses, a business that Warren Buffett would describe as having a moat around it, right? If you believe that the value of anything financial is the present value of the cash you can take out of it over its life, well, you need to know how much cash it's going to generate over its life. So business quality to us is the single most important criterion for determining what's interesting. Because if we can't predict the cash flows, we don't know what it's worth. If we don't know what it's worth, we can't invest. So we figure out what it's worth, we figure out how good the business is, how predictable will this cash flows be from a railroad or a spirits company or a real estate company, shopping mall business. And then we say, okay, well, where's it trading? And if there's a wide gap between price and value, you can buy it for 50 cents, it's worth $1.20, well, then we're going to take a hard look and try to understand why it trades at a deep discount. And once we understand the reasons, we decide, well, these things that we can solve. Or can we, in light of the situation, the circumstances, can we be influential in changing these levers that can cause this valuation discrepancy to narrow? And is this a business that, while we're causing the valuation discrepancy to narrow, we can also perhaps contribute to the valuation growing?
Let's go to 13. I'm Isaac Dimitrovsky from New York City. Mr. Buffett, it's great to be here. I've read that there were several times in your investing career when you were confident enough in one idea to put a lot of your money into it, say 25% or more. I believe a couple of those cases were American Express and the Washington Post in the 70s, and I've heard you discuss your thinking on those. But could you talk about any of the other times you've been confident enough to make such a big investment and what your thinking was in those cases?
Charlie and I have been confident enough, if we were only running our own net worth, I'm certain a very significant number of times, if you go over 50 years, there have been a lot of times when you'd have put at least 75% of your net worth into an idea, aren't there, Charlie?
Well, but 75% of your worth outside Berkshire has never been a very significant amount.
Well, but I'm going back. Let's just assume it was. Let's just assume you didn't have Berkshire in the picture. There have been times, I mean, we've seen all kinds of ideas we would have put 75% of our net worth in.
Warren, there have been times in my life when I've had more than 100% of my net worth invested in things.
That's because you had a friendly banker, and I didn't. No, there have been times, well, initially I had several times I had 75% of my net worth in one situation. There are situations you will see over a long period of time. I mean, you will see things that it would be a mistake if you're working with smaller sums. It would be a mistake not to have half your net worth in. I mean, you really do sometimes in securities see things that are lead pipe cinches, and you're not going to see them often, and they're not going to be talking about them on television or anything of the sort. But there will be some extraordinary things happen in a lifetime where you can put 75% of your net worth or something like that in a given situation. The problem has been the guys that have put 500% of their net worth in. I mean, I mean, if you look at, just take LTCM, very smart guys, very decent guys, some friends of mine, high grade, knew their business, but they put, maybe 25 times their net worth into things that were a cinch if they hadn't have gone in that heavily. I mean, they were in things that had to converge, but they didn't get to play out the hand. But if they'd had 100% of their net worth in them, it would have worked out fine. If they'd had 200% of their net worth in it, would have worked out fine. But they instead went to, maybe 2,500% or something like that. So there are stocks. I mean, there's quite a few people in this room that have close to 100% of their net worth in Berkshire, and some of them had it for 40 or more years. Berkshire was not in the cinch category. It was in the strong probability category, I think. But I saw things in 2002 in the junk bond field. I saw things in the equity markets. If you could have bought Cap Cities with Tom Murphy running it in 1974, it was selling at a third or a fourth what the properties were worth, and you had the best manager in the world running the place, and you had a business that was pretty damn good, even if the manager wasn't. You could have put 100% of your net worth in there and not worried. You could have put 100% of your net worth in Coca-Cola earlier than when we bought it, but certainly around the time we bought it, and that would not have been a dangerous position. It'd be far more dangerous to do a whole bunch of other things that brokers were recommending to people. Charlie, you want to comment?
Yeah, the students of America go to these elite business schools and law schools, and they learn corporate finance the way it's now taught, and investment management is the way it's now taught. And some of these people write articles in the newspaper and other places, and they say, well, the whole secret of investment is diversification. That's the mantra. They've got it exactly back-assward. The whole secret of investment is to find places where it's safe and wise to non-diversify. It's just that simple. Diversification is for the know-nothing investor. It's not for the professional.
And there's nothing wrong with the know-nothing investor practicing it. It's exactly what they should practice. It's exactly what a good professional investor should not practice. But there's no contradiction in that. A know-nothing investor will get decent results as long as they know they're a know-nothing investor, diversify as to time they purchase their equities and as to the equities they purchase. That's crazy for somebody that really knows what they're doing. And you will find opportunities that if you put 20% of your net worth in it, you have wasted the opportunity of a lifetime, in terms of not really loading up. And we've had the chance to do that way in our past when we were working with small sums of money. We'll never get a chance to do that working with the kinds of money that Berkshire does. We try to load up on things, and there will be markets when we get a chance to from time to time, but very seldom do we get to buy as much of any good idea as we would like to.
Because the markets have been going through these wild gyrations, don't seem to have a clear sense of what direction is up. How do you interpret that as somebody who's spent a lot of time playing the market?
Put on my, manage the portfolio trader hat, and not so much a trader, but manage the portfolio. It's great, anytime there's volatility and any time there's change, there's opportunity. Now, I say it's great because I've taken a whole different approach to investing than most people. I think buy and hold's a crock of I think, the idea that you always have to invest your cash is not far behind. And so I've always been of the attitude that unless you really have a commitment to something, just keep your money in cash, knowing that at some point in time, there's going to be a week or two like we've had.
But how much time, you've got a lot going on in your life. How much time do you have to actively manage your portfolio through these 500-point market swings?
Well, see, that's the whole thing. I don't have to spend much time until it hits the fan, right? So I don't,
a lot of hitting the fan this week.
Well, that's exactly right, and that's where the opportunity is. Like, I wouldn't look at my portfolio, or I get a one-line, one-number statement every day from my bank, and that tells me if anything weird happened, and I wouldn't even look at it. But then when everything starts getting crazy, I call it the World Series of investing. That's when you start digging in, and it's because of the approach that I take. So, back in 2006 and 2007, I was writing blogs saying, look, the stock market's for suckers. You're getting put, when you sit down at the business table, you always look for the sucker. And if you don't see it, it's you. And you've got all these professional people on the other side of the trades. When I started trading stocks in the early 90s after I sold my first company, you could understand different elements of the market better than the professionals. So I can understand, new technology from Wellfleet and Synoptics and all these old technology companies better than the traders. Today, there's so much money in these huge hedge funds, and then they have such professional research and in-depth research, there really aren't any advantages for the individual traders. And so my approach has always been, unless I know something specific, put it in cash. And so
what are you investing in? What are the areas that you feel you know?
What I did in 2008 and 2009, I put everything into MLPs and MREITs, mortgage-backed securities, ones that I thought were the better companies, and I just piled in. And I also piled into Australian bonds because I thought the economy was good next to China. It was my way of playing China.
So you make one-way bets. This isn't portfolio balancing you're talking about.
No, all that asset management, diversification, that's for idiots, right? Because you can't diversify enough to know what you're doing, right? I did my homework on Australia, right? I did my homework on the MREITs. I did my homework on MLPs, and their pricing had just gotten crushed.
So what are you doing right now?
So what I did right now, I'd been going all the dividends and everything. I just put into cash, and so I don't think stocks have fallen enough to just to say any particular stocks are cheap. Right. So when I looked at the MLPs in 2008 and 9, they were paying 18-19% for companies that had never missed a payment, right? Had always put out all their cash, and they looked dirt cheap. Now, you look at good companies. Apple hasn't fallen that much, and just to be down 10-15% from their highs, they're still not as low as they were 18 months ago. And so what I did was I said, self, there's going to be a lot of volatility. So I bought, took a little bit of money and bought out of the money calls on the spider calls I bought on the Standards & Poor's, the SP 500, and then I did the same thing on the diamonds, which is the Dow Jones. So I bought those long when the stock prices cratered, and then when we had the big, not today, but the big run up before, I bought a bunch of puts, knowing that even though I was paying for a lot of volatility, that I thought there would be a lot of swings in the market. And so you're just betting on volatility. I'm just betting on volatility.